The broadcast is now starting. All attendees are in listen-only mode.
Hi, it is now about 2 minutes before 6, 4 minutes before 10. I'm sorry, I got up very early to drive down here. It's about 2 minutes before 10. We'll start just about on 10 o'clock. So give us a couple more minutes and then we'll be moving forward. Thanks. Hi, it's still a couple of minutes before 10. I have the question thing on. If you have any questions before we start, probably not on this point, but on something else that you think I might know, feel free to type it in, and if I can answer it, I will, and we'll go from there. Thank you. Okay, my little clock on the wall says it is 1 minute past 10. So let's see if we can get started so that we can go through this. Let me start my introduction by saying, basically, if we wanted to do a detailed analysis of this subject, we would not be doing it in an hour and a half or 2 hours. We'd be talking probably about 2 days. So please understand that in the large, we're just doing an overview here. If you have questions, feel free to ask them. This is my picture. Yes, I'm old. That's a very old picture. My hair is a very different color now. The telephone number that you see there, that is my cell phone number. I am very, very rarely down here in the office, so that, the easiest way to reach me is from my cell phone number, which is there, or my email address for Gregory and Gray. The other way you can reach me is my personal email, which I will give you. It is very complicated. It is Mike, M-I-K-E, at the Koppels, THEKOPPELS.com. You can use either one to reach me. I don't hang around on the phone. I don't hang around on email, but I do check it once or twice every day as long as we're around. Okay, rules. Rule number 1, and these have been my rules as a speaker for a lot of years. Some of you that have heard me speak know that I believe these very strongly. I believe very strongly. I will try very hard not to be political. I may make a comment about whether I think the particular regulations make sense or don't make sense, but I am not going to pick on any politician. I'm not going to pick on any rules, and my political views are mine, and they don't matter. You can say whatever you want. You can type in whatever you want, and as long as it is reasonably polite, I will read it and answer any questions that you have as we go. There is no such thing as a dumb question. I believe this very, very strongly. Taxes are incredibly, incredibly complicated. They change constantly. So basically, there is no such thing as a dumb question. There are things that you may have known that were true last Friday and may not be true anymore. So don't be afraid to ask anything, type in anything you want as we go through. Do not hold your questions. That doesn't work. I don't believe in that. If you ask a question and then I know that it's going to be answered later on, I will say so. Other than that, please, if you have a question, go ahead and ask it. Anytime, 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 anytime. I can't overemphasize that. The whole issue that we have here is one of expense versus capitalization, and those of you that have been around a while know that this has been a problem between the IRS and businesses forever. It's one of the first things the IRS does is go through and look for your list of what did you call repairs, and they're going to go through and say, no, you should have capitalized this, no, you should have capitalized this. And the rules were vague and hard to follow, and what they've tried to do is make them more meaningful. However, before we start talking about repair versus expensing and which is which, I want to bring something to your attention, and this is important because I believe, and a lot of people believe, that to some degree this is a groundbreaking case. That's number one. The reason that I think it's important here is this case happened, it's a bankruptcy case, number one, all right? But it happened to come down right here in Eastern Massachusetts. I'm not going to give you the judge's name or anything else. If you want to know that, you can look it up. But hopefully I'm going to be writing a quickie summary of this case in the next week or so to go out on Graham Gray's news list. But basically what happened here, and this is a bankruptcy case, and those of you that have a business, an operating business, and also own the real estate, one of the things that advisors have been doing forever is we've been saying keep the real estate for your operating business, I have no idea what that was, outside of the business. So what we're talking about here is we have our operating business, and we have where the real estate is. The operating business is a corporation. The real estate is in an LLC. And what happened is the operating business went into bankruptcy for various and sundry reasons. And in bankruptcy, the bankruptcy judge ruled that there was substantive consolidation between the LLC holding the real estate and the operating company, and therefore the creditors, right, could use the assets of the real estate LLC to satisfy the debts of the construction company, of the operating company, even though there was nothing saying that they could do that. Now, I will tell you in reading this case that basically everything was done wrong. Right? They did lots and lots of things wrong that led to the judge being able to say this. But I'm bringing this to people's attention because we do this all the time. We recommend this all the time. And in dealing with various things, I talk about there being a cookbook for things. What happened here is the people didn't follow the cookbook for keeping the LLC totally separate. I'm not going to get into all of the things that were there, but it is very, very important, and when I write this, and hopefully it'll go out in the newsletter sometime in the next couple of weeks, it is very, very to understand that you make sure that you follow the cookbook that is out there. This case came down in March, so it's really, really important that everyone understand it. I don't know what that digging is, but all right. Why are the new rules for this? And then the reason is, like I said, it's been a problem forever and ever. So what the IRS tried to do is to make the new rules more understandable. And you'll decide in a little while whether or not this stuff is understandable. And the other thing they were trying to do is to increase compliance. Now, my tangential comment here is that some of you that know me know that pretty much what my job was for over 40 years was to take the IRS rules, to take the Internal Revenue Code, to take all the regulations and analyze them and twist them around so that we could do what is best for the taxpayer, even if that was not what the intent was in the regulations, because the regulations were written in such a way that we could do that. And we're going to see a couple of situations where that may still exist. All right. First thing that we have to understand, and this is probably the most important takeaway that you're going to have in this discussion, and that's the de minimis election. De minimis means small. I was not an English major, but I understand what de minimis means. So first thing you have to understand is that the de minimis election is an annual election that is made by a check mark on your tax return. Now, I also know from over 40 years of experience that basically taxpayers get the tax return and they just sign it. They don't do a tremendous amount of review as to what was done, because we trust the tax preparers. And Gray is outstanding, and they will absolutely have made this done. Make sure that it's done. You should be reviewing your tax returns anyway, not just signing them. Now, I'm using the word discrimination not in the normal way that we talk about it, but in what happened in this particular case is that certain taxpayers were discriminated against, and some of us fought this very, very hard. We got a partial victory, but there is still a discrimination here. So the first thing you have to understand is there is something now called an applicable financial statement. An applicable financial statement is something that is sent to the Securities Exchange Commission. Second thing, it's required by some other governmental agency. All right? They're requiring that you file a financial statement with them. Or it's a certified financial statement, what we call an audit. So you've gone out and you've had your financial statements audited, and it is for the benefit of loans. Normally a bank is in their requirements had that they have to have an audited done and sent to them for your loan. Or it is done for the stakeholder. Now, I know very few stakeholders. Stakeholders are shareholder, member, partner, whatever. I know very few of those where their agreement says that there has to be an audit done. Right? Or some other non-tax reason, and I have no idea what that means. I've asked people, and I can't find of anybody else that knows why you'd have a non-tax reason other than the ones that are stated in order to have an audit. Now, this is where the discrimination comes in. If you have an applicable financial statement, right, your de minimis amount, very, very important you recognize the de minimis amount is $5,000 with an AFS. However, if you don't have an applicable financial statement, the de minimis amount is half of that, $2,500. Why is this important? And you'll notice the little graphic that I have over here that's an invoice. The reason is this. That amount, the $5,000 or the $2,500, is the de minimis amount that you can just expense. Don't have to say what it's for. Don't have to worry about anything else. You can expense it if it is a one-item person, single line item, or the entire invoice. If that is the case, you can just expense that amount. It is considered de minimis. So basically, what has happened here is that this set of regulations has really divided businesses into two layers. One layer, which are audited clients that have an audited financial statement, and all of the rest, closely held businesses, usually, that do not have an applicable financial statement, do not have an audited financial statement, only have $2,500. which means that we have to really pay attention, especially for those items that don't have an audited financial statement, as to what we can do. Please, please, please pay attention. Remember, when we go back here, this is per invoice. So that one of the things, and one of the things, and I will give you an example of when I was doing this presentation for somebody else, and I was talking to one of the people that I presented to after the fact, and it happened to be a fairly high-end restaurant that was redoing their seating area. And all of the tables and chairs and everything else were going to add up, and they don't have an audited financial statement, obviously. We're going to add up, when you added it all together, to about $12,000. And they said, well, that means we're going to have to capitalize this. And I said, wait, stop. Do you think your supplier would consider doing this in multiple invoices, each set of table and chairs, each booth separately? And the answer to that, when they went and asked them, was yes. So what we did is we went from having to capitalize that seating area to being able to expense that seating area. Now, is that right? Is that intent? Clearly that was not the intent, but the way the regulation is written, which is vague, and there is nothing out there stopping this right now, that basically that is something we can do. We have to be a little careful on how we do it, make sure the invoices are properly done, make sure purchase order is properly done, so that there is nothing that says that this is done along the way. And in that particular case, we were able to do that in order to make it so that we could expense immediately, as opposed to capitalizing and depreciating over time. Okay? All right. I believe very, very strongly in written capitalization policies. So that basically one of the things that is, whether it's required or not, is up for grabs. I believe that there should be a written capitalization policy, so there is no question whatsoever. Now, if you write the written capitalization policy, what if you do something that is in excess of the written capitalization policy that you've done? If that is the case, if the written policy and your capitalization, if what you buy is above that, it doesn't matter what the de minimis rules were. It matters what your capitalization policy was. Same thing is true if what you buy is less than the limit. If you're less than the limit, as long as you're also less than the regulation says, then what you have is you're in good situation where you can do this. Now, in order to make your life easy, what I've done, and I've copied this, and you can see down the bottom that I've given credit to the law firm that actually wrote this. And there are several others, and my microphone is falling apart, but that's okay. There are several others that are out there on the internet that you can find. This one is there. It's fine. It has everything you need there. There are others that you can use. So basically, you can cut and paste this, copy this, as this can be your capitalization policy. Just fill in the blanks, obviously. Approved by whomever, whatever their title is and date and so on. And basically, once you have it, you just keep it in your right-hand drawer, and you have it so that you have now your written capitalization policy. I believe that all entities, I'm going to repeat that, I believe that all entities should have a written capitalization policy that is in their right-hand drawer. Obviously, they're not hard to do. It's right here. And, you know, if you don't like this one, go out on the internet and you can find some others as well that, you know, you can use if you don't like this one for some reason. Okay. Election to capitalize and depreciate, what does it mean? I assume that all of you know what this means. If you're going to capitalize something, that means that you're going to go out there and you're going to have to depreciate it over its depreciable life. Now, one thing you have to understand is that depreciable life does not necessarily mean its useful life. That's kind of a misnomer. Depreciable life is something that is absolutely set by tax law and is very fixed, so that you're capitalizing and you're depreciating over time, which means that over somewhere between 3, 5, 7, 15, 29, whatever years, you're going to wind up having to depreciate the item as opposed to being able to expense it and reduce your taxable income immediately. Right? So, All right, this is something that is actually pretty remote, that you're actually going to have to use it, and it's kind of backwards in my view. So basically, one of the things that you can elect to do, and we're going to talk about all the elections that you can do at the end. One of the things that you can elect to do is you can have if your financial statements and your tax returns use the same capitalization policy and same depreciable policy, if that's the case, then what you can do is you can elect to say that which I have capitalized for financial statements, I have also capitalized for my financial statements and tax. I've capitalized the same things. Therefore, what I've capitalized can't be questioned. Now, I want you to stop and think about what that says for a second. The vast majority of businesses that I know and I've dealt with over time, their concern is not how much they can capitalize, it's how much they can expense. So basically what this rule says is kind of backwards to what we would want. We would want to say, okay, if I have expensed something for my financial statements and expense something, my tax return, it can't be questioned by the IRS. This does the opposite. So that basically, while this is out there and it's an annual election that you can make, and therefore I had to comment on it, I don't get excited about it because I don't think it really helps us as much as we would want. It is something that you should be aware of, and if you think it's appropriate, you should use. But you have to understand that it really doesn't get you where you want to go, which is expensing as much as possible. Okay. We have a new concept. Not entirely new, but fairly new concept called a unit of property. And this is a vital, vital concept that you have to understand. And the concept is actually pretty straightforward in its definition. It says all components that are functionally interdependent. Functionally interdependent. So what is functionally independent? Well, let's see. If I'm a manufacturer and I have a conveyor belt and people have 3 or 4 or 5 machines going down the conveyor belt, does that mean that each of the machines that is on that line, on that production line, are they functionally interdependent because you couldn't finish the product without one or other? Or they're not functionally interdependent because I could stop the line and take something off, take that piece of equipment offline and replace it. So is it functionally interdependent or isn't it? And that's a very good question that is not answered really. The regulations don't do a very good job of answering in that situation. So functionally interdependence is a key component, because what's going to wind up happening here is I have that entire production line, and now that entire production line is one unit of property. And that means that because it's one unit of property, all of a sudden I have to look at it when I'm doing my repairs and maintenance and replacements as one great big line. And all of a sudden, all kinds of things become much more difficult. The larger the unit of property you have, the more interdependent it is, the harder it's going to be to expense things as you go along. All right. As far as whether or not something is considered capitalizable, there are some different words we have to now learn. And unfortunately, I wasn't an English major, but we now have words that we have to use that you'll understand. What is a betterment? A betterment is something that ameliorates a condition or existed before the acquisition of property arose or arose during the production. So basically what I'm doing here is, think about it this way. I am now taking and I'm making a betterment. I am taking a product, I am taking a machine, and I'm making it better because I'm taking a component out that used to do 10 products an hour, and because I put this new one in, it does 20 an hour. So the first question you have to ask is, does it make it better? Yes. However, let's suppose that I have an applicable financial statement, right? and the product, and it costs less than $5,000. It costs $4,000. It is therefore de minimis. This is why the de minimis exception is so important. Basically, all the things that we're going to talk about now that require capitalization, if you can get it into the de minimis exception, it doesn't count. So the de minimis exception is really, really important, and that's why when we go back and talk about the importance of an invoice, that's why we talk about it, and that's why it's important that you understand what it can do and how you can do it. All right, it's a material, same thing, material addition to property, increases productivity, efficiency, strength, etc. of the property. All of those things are a betterment. And that makes sense when you think about it. So basically what you're doing here is you are taking this unit of property and you are making it better. You're making the condition better. You're taking something that the productivity of it has declined over time, and you're bringing it back up to where it was. You're taking something that used to do 10, now does 20. All of these things are considered a betterment, right? Unless, of course, you make the de minimis exception. Second thing, and I happen to like this particular graphic because, as some of you know, I like funky things in my productions. So one is it adapts. So something, all of a sudden, it takes and it adapts your unit of property and makes it something new. It is inconsistent with the usual use. So that basically is taking a machine, and that machine used to be able to make widgets. Right? And now all of a sudden you've taken a component of that machine out, and instead of making widgets, it makes wadgets. Right? So basically what it does is it takes what was the original intent of the machine, which was to make widgets, and now it makes wadgets. So basically what you've done is you've taken that unit of property, you've taken that machine, you've taken that production line, you've taken that unit of property, and you've changed what it was. You've changed what it did. You changed what it was used for to a new thing. So that basically if what you've done to that machine, to that line, makes it can do something new, again, you have to capitalize it unless de minimis cuts in. You're going to hear me talk about de minimis a lot. Restoration, all right, it's just what it says. Basically what you've done is you've returned the unit of property to a working order from a state of disrepair. So that basically, and you can see the little chairs over there, what has happened is the chair has deteriorated, the value of the chair has deteriorated over time, so there's no longer safe to sit on, and what you've done is you put things in so that it now returns it to working order. And because you've returned it to working order, you've restored it, obviously that's considered a restoration. Right? And what you've done is you've rebuilt the property to like new condition. Right? Makes sense. Okay. Oh, good. There's something here. Hang on. Can a capitalization policy include different thresholds for different classes of equipment? The answer to that is yes. All right. So that if you want to have a capitalization policy and you want to have different levels, all right, for different types of things you absolutely can do that. However, remember what I said. If you put a capitalization policy in place and you say that, okay, this widget has a capitalization of 1,000, that wadget has a capitalization of 2,000. And all of a sudden you do something to this widget that you had a capitalization policy of only 1,000, and you put something in there for $1,500, you just blew your de minimis. So what I've been advising people to do is, although you can do it, I wouldn't do it. I would have one capitalization policy for everything, and that capitalization policy should be the maximum amount that is included in my AFS, either my $5,000 or my $2,500. Whatever that is, that's going to be my capitalization policy. Because remember, if I have a capitalization policy in excess of that amount, the IRS isn't going to care. The IRS is going to come in and say, fine, you can have whatever you want. You want to have a $10,000 capitalization policy, go ahead. However, we, the IRS, when we come in, assuming you don't have an audit, we're going to just sit here and we're going to use the $2,500 anyway. So my advice to people, in what I've been telling them to do, is always use the maximum amount that is currently allowed in the regulation, the $2,500 or the $5,000. You can do it. You can break it up. You can have different amounts, but it really doesn't get you anywhere. Okay. All right. Or it replaces a major component or a substantial part of the property. So basically, that's the same thing. We're talking about restoring something, bringing it up to where it was. A major overhaul of an engine, something along those lines. It is something that you really have to sit here and say, okay, what else is out there that is going to bring something back? And you really have to look at it. Routine maintenance, right? And this is something that is expected to happen more than once during the life of the asset and not result in a betterment or any of the others above. So the example that's here is obviously an oil change. I'll give you a perfect example. Where I live up in the mountains of New Hampshire, wherever we go, pretty much outside of our little valley, we take my car instead of my wife's car. So basically, my wife's car drives something in the vicinity of 1,000 miles a year, and she just bombs around locally. However, I am told by people that are knowledgeable in cars, which does not include me, that basically you should have your oil changed every 6 months, whether it needs it or not. So basically, what we're talking about here is we're going to change the oil every 6 months, right? Period. It's going to happen. It's going to happen every 6 months during the life of her car. My wife's car is 5 years old, and she now has 17,000 miles on it, and that included a couple of years while we still lived in Massachusetts, and she was driving a lot more. So basically, that's what routine maintenance has. So you have to sit here and say, what am I doing that requires me to do this multiple times during the life of the asset? Now, what is interesting here is the definition of life of the asset. So, for example, when I look at a car, what is the life of a car, right? My car, Subaru Outback, I put on 15,000, 18,000 miles a year as I drive around because we take my car where we go places. Right, so I expect to get 150,000 miles out of that car. So I expect that car to live for close to 10 years. Is the depreciable life of a car 10 years, according to the Internal Revenue Service? No. So what is the life of the asset? What is the life that you're looking at? So most of the time, the vast majority of time, the depreciable life of an asset is much lower than the actual life of an asset. So, but basically what they're talking here is they're not talking depreciable life. They're talking about the real physical life of an asset. In the vast, vast majority, and I can't think of one, but in some cases, it may make a difference, and if it does, you should understand what the difference is, and it doesn't do a betterment, and we talked about what a betterment is. So you really have to look at this and see what makes sense and what doesn't make sense. All right. I put this in because somebody asked me a question, and that is called a partial disposition. So let's go back and talk about, we have an assembly line, and on that assembly line are 5 different machines, 5 different stations with machines on it. And all of a sudden you decide that this machine in position 2 is no longer the machine you want there, and it's been, it has a useful life of 7 years, and it's 4 years in. And you decide that you're going to take it and replace it with something because it's a better updated machine. So you're going to take this machine out and you're going to put the new one in. how do you recognize gain or loss on that item? That item is part of a unit of property. Because it's part of the unit of property, you probably didn't have a separate item class based on the new rules for that item. So basically what you're going to have to do is, this is an election that you can make. You can make an election, again, on your annual tax returns. We'll talk about all the elections. I'll give you a list at the end. This is an election that you're going to make that says that I'm going to be able to take that particular item that I took out, and because I disposed of it, let's suppose I just threw it in the junkyard so I get nothing for it, I'm going to be able to go through and I'm going to be able to calculate what its actual depreciated basis is and say that I got a loss on that or gain on that if I sold it. But that is something that if you don't make that election, when you take that item and junk it, sell it, whatever, if you did not make that election, all of a sudden you're not going to be able to do this. It's just going to continue to be part of the basis of the entire assembly line. I'm using assembly lines as an example, but it obviously applies in almost any type of situation. So once again, this gets rather complicated, obviously, but it's a simple election. And one of the things that I like about this particular regulation is that there are simple elections that you can make every year that may make your life much, much easier as you go. And this is why I go back and said, when I talked about you should absolutely have a capitalization policy. I gave one to you. I assume that you can print the page. If you can't print the page, I gave you where to find it online, and you can print it from there, and you can handwrite the amount in for $5,000 or $2,500, just fill in the bottom. Or if you have OCR, you can do it from there. I did it from there. If you can't get any of those things, you have my information, email me, and I can send it to you in Word format. But it's very, very important that you go through and make sure that you make the elections we're talking about. And this one, even though it doesn't make sense to you initially, it doesn't cost you anything to do it. So it is something that I like things like that. Here's something that makes absolutely, again, no sense to me. And here we have an election to capitalize the employee compensation or overhead for self-constructed assets. Now, you have to do that anyway. Right? You have to do that. If you're building your own machine, if you're building your own whatever, right? You're installing your own windows in an environment, you're building you're putting in your own doors or whatever it is, you have to capitalize the assets. Now, the place where it might make sense, for example, is let's suppose that you're in real estate, and what you're doing is you're having your people go out, and your people are going to go and put all of the televisions, for example, in there. So that basically, in that situation, the election to capitalize would make much more sense than the otherwise. But this is one where, I think that if you do not do this anyway, the IRS is going to come in and they're going to have a problem with you. All right. The IRS has come down in this regulation, and they have gone into real estate, and they have said, wait a minute, we know that in a real estate environment, there are multiple things within a building, within almost every building. And those things, you can break them out. They should be broken out as to what the unit of property is, when you can depreciate them, what you do for repair and maintenance within it, and so on. So they've come down and they've listed several things. Now let's see if some of these make sense to you. The first unit of property is HVAC. Heating and air conditioning absolutely makes sense. All the ductwork, all the units on the top of the building, all of those things are a separate unit of property. All the plumbing systems, right? Everything that ties into the sewer, all the plumbing work inside, all the toilets, sinks, etc. All of that makes sense. That's a separate unit of property. All the electrical systems, Now, all the electrical systems, I do not include in electrical systems, I do not include light fixtures. I think light fixtures are separate and distinct because they are really commutable. I can take them on and off and put whatever I want, as opposed to all the wiring. And again, I'm not an electrician, so anything I say that sounds stupid, I apologize. All the wiring and all of the we don't use fuses anymore. All the circuit breaker switches and everything else, all of that makes sense as an electrical system. All of that is now one unit of property. I separate out when I talk to people. I don't believe it includes the fixtures. Escalators, that makes sense. Elevators, same thing, that makes sense, separable. Fire protection and alarm systems, absolutely separable. Now, I am told, although I don't, again, understand it, that a lot of fire and protection systems can be incorporated into electrical systems or incorporated into the cabling systems. So if that's true, that's fine. I don't understand it, but I'm told that it's true in my house. Security systems, same thing. I don't understand how a security system is different from an alarm system, but that's just my thing, but I'm just using the list that they gave me. Gas distribution systems, if you have a gas system, my house at home is on propane. So basically everything that went from the great big tank that's outside all the way through my house and all the rest of the stuff is all part of the gas distribution systems. And this is my loved one. Whatever future guidance says, which basically says that if the IRS wants to add something to this list, they can. Now, all of you people that have real estate, I want you to stop and think for a second. Can anybody think of any major items in real estate, in buildings, that's not on this list? And I'll give you a hint. It starts with an R. And it is one of the things that is one of the biggest questions when we talk about whether or not something happened. The roof. Right? Anybody see the roof as a unit of property here? I don't. So basically what we have is that one of the biggest items that we have if we have real estate, and we talk about whether or not something is a repair to the roof or it's a whole new roof, is the roof a separate unit of property, or is it part of the entire building envelope, entire building structure, right? So is it the roof now part of the entire structure, right? Which means that we can't separate it out when we talk about whether or not we're doing repairs or whether it's capitalized. Now, my position is this is just an oversight on the part of the IRS. I think there are two oversights in this case. I think one of them is the roof, and the other is parking lot, garage, whatever. I think those are two major things that they've kind of missed in this case. We've been able to tell the IRS that we think that they should have included these things. Whether they will include them or not, I don't know. But right now, this is the way it is. It is not a separate item, which makes it very difficult when we're talking about whether it is a betterment, whether it's whatever. So, you know, it comes down to something that's very interesting. So that basically, if I replace the roof, if I put a new roof on a building and it returns it to its place, is that capitalized? Absolutely. If I just have one part of the roof that is leaking significantly, right? Let's say I have part of the roof that is leaking significantly into the building so that the building now is not being able to be used. And I replace that. Did I just bring that building back up to a useful state? The answer to that is yes. So all of a sudden, what I have now, depending upon the size, all right, unless I have a de minimis, I now have a whole different area of what was capitalized when I thought about it before. So there are different things that we have to talk about here, and these are things that some of us are discussing with the IRS. So what does the IRS consider real estate? And this is pretty straightforward. This is pretty simple. It's a building or a building system. Anything that you've leased, if you've gone out and leased the building, It's obviously real estate, condos, co-ops, right? It includes the real property and the personal property that is in the building. So all the personal property, all the televisions, refrigerators, stoves, etc., that is inside the building is considered part of the building, is considered part of the real estate unit. Any improvement that you make to the property, you buy something and you bring it up to sleep, you add something to it, you add new windows, whatever else, it's all part of the real estate property. Components with different classes are all part of the real estate. All of this makes sense. Plant property is all part of real estate. I don't know what network assets means, and the regulation really doesn't do anything to explain it to me. So I put it in there. Maybe somebody can tell me what it means. But basically, these are the units of property. It's pretty straightforward. It's pretty obvious as to what is in there, what is you have to worry about. I'm taking a deep breath before we start this. I'm now going to explain to you something which doesn't make sense, because it is actually pretty important if it applies to you. And that is one of the things that when the regulations first came out, and some of us made comments, and some of us had the ability to work with people on comments. One of the things we said is, you know, small real estate people that don't have a lot of real estate, we got to make things simple for them. And they said, yeah, okay, we're going to do that. And this is what they came up with. And let's see if we think this makes sense. Someone that has small real estate, a small real estate owner, is someone with gross receipts from real estate of $10 million or less. Now, I don't know right now what the conversion is, but let's suppose, because I can do the math easily without keeping my hands on the table and not taking my shoes off, let's suppose that basically what you do is you say, all right, I have something that is worth 20 million, I'm worth $50 million. So if I have something worth $50 million, how much do I have to charge every year to cover my debt, to cover everything else? And let's suppose I divide by 5, and that's low, but I divide by 5 to get to my $5 million. So simplistically, that means that somebody with $50 million worth of real estate would qualify for this. All right, so all of a sudden, $50 million worth of real estate, I'm not sure that qualifies as a small taxpayer with buildings, but you know what? It's in the taxpayer favor, so I'm all in favor of that. Anything the taxpayer favor. Now we come to something that doesn't make sense. All right? We just said that this is a fairly significant owner of real estate, but what we now say is the building unit of property has to be $1 million or less. So let me repeat that. The building unit of property has to be $1 million or less. So we just did our simple case, and we said we have buildings worth $50 million. However, in order for this to apply for the small business, a small business owner, small real estate business owner, the unit of building has to be $1 million or less. So that person has to have 50 buildings. That doesn't really make sense, but that's the way it's written. And now comes the really fun part. Okay? So you would say, all right, what we're trying to do here is we're trying to take and say, okay, we have a person, a small real estate owner, and we're trying to make it easy for them to minimize the bookkeeping they have to do, to minimize the depreciation schedules they have to do, to make it easy for them to do. So what we said is, let's assume this person does qualify. They have $10 million or less of gross receipts, and the unit of property, the building, is worth $1 million or less. So what do we have? That person can take the lesser of $10,000 a year, or 2% of the adjusted basis of property. So does that make sense to you? Does it make sense to you that what we're trying to do is take someone's building, all right, and take the repairs and maintenance that they don't have to keep track of, they don't have to capitalize, they don't have to worry about the de minimis policy, and all of a sudden say, okay, it only applies to $10,000 or 2%, the lesser of 2%, which obviously in almost all cases is going to be $10,000, because I can take 2% of $1 million is $20,000, so that's obviously going to be $10,000, and that's all I can do for, and not worry about it, not worry about whether it applies to all of the rest of these items, not worry if it's a betterment, not an adjustment or anything, or whatever, restoration. I don't have to worry about any of that, but it only applies to $10,000 if I meet these criteria. So one of the things that we have suggested, several of us have suggested to the service, is that, you know, maybe we should make this a little bit clearer. Maybe we should increase the building unit of property. Instead of $1 million, maybe $10 million or $5 million makes more sense. And maybe instead of $10,000, maybe $25,000 would make more sense before we have to worry about our 3 criteria and our de minimis exceptions. That is something that we are suggesting to them. We're finding them to be a little bit resistive, but we'll see what happens. It is something that some of us are discussing with them as we go forward. Okay. We're getting near the end. I know this is incredibly boring stuff, but you have to talk it through. Here are my annual elections. All right. The first is to capitalize rotatable, temporary, or standby emergency parts. I'm not sure that I know what that means. Well, actually, I do know what it means. I can use it in the case of a trucker. In the case of a trucker, we have rotatable parts. We have temporary parts that we keep on hand. We have things that, tires, for example, in a trucking industry, other things that they keep on hand just in case, so that we would be able to make an annual election for those. We talked about partial disposition, with de minimis safe harbor, capitalization of employee compensation overhead. The small business is an election. If you're there, you should be making it anyway, and compliance with book reporting. These are simple elections. They're right on the tax return. It's right there. I hate to say I don't look at tax returns anymore. I don't look at business tax returns anymore, but my understanding is right there, check, 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 and it's automatic check. You set as a default in tax preparers, and it automatically checks those unless you don't want them. I can't think of why you would not want any of these. They may not apply, but it doesn't hurt to have them anyway. So this is something that I suggest to people that they do. All right. Change in accounting method. The service allowed back several years ago, 2, 3, 4 years ago, it said, okay, if you're doing something that is wrong, something that is contrary to what these regulations are saying, or anything else, it allowed you to go and change your accounting method and do it pretty simply, you know, so that it wasn't a big deal to do. I assume you already did this because the time to do this simplicity has passed. If there is that type of situation where somebody comes along and says, maybe we're not doing this right, maybe we're not in compliance with the regulations, maybe there's something we want to change, you know, give me a call and we can talk it through. Quite simply, I will tell you that I've told people now to just go ahead and do it. Unless it's huge, just go ahead and do it, and move forward. There aren't a whole lot of situations that I know of where this has kind of happened in the vast majority of businesses, unless you're a Fortune 1000 or Standard & Poor's 1000 company. This isn't going to happen with you. But it is something that is out there. I've had some people call me and ask about this, especially when they were doing something that's just plain wrong. They were using a method that was not allowed previously. and they could have gone and pretty simply changed to something that was allowed, and they missed the window, and we've talked through what to do that in that case. So I'm assuming you already did that. Hang on. Somebody has left me a very long note. If I have an upcoming IRS exam and I know that my accounting methods, documentation, or past policies are lacking, do you have any suggestions how to approach the impending audit? I will first give you my sarcastic answer. My sarcastic answer is pray. My second is that I would want to really see how different you are. I mean, are you really totally outside? Did you do things that are just plain wrong and you can't defend it in any way? So that basically you knew it should have been capitalized. You know, everybody here knows we do a lot of McDonald's work, and basically I replaced the entire lobby and expensed it. All right. Clearly that is wrong. Clearly that's not going to fly. If you did that, you know, my suggestion in those situations, you know, where clearly it is just plain wrong, and clearly you know that the service is going to find it. My advice in those situations has always been, and you may not like this, but my situation has always been to come clean right up front. And my reason for doing that is this. My experience is that if you come clean right up front and say, oh, we did this, it's wrong, here it is, I'm giving it to you. When that's the situation, the IRS says, wow, these are pretty good guys, whatever. If they go through and they find it, once, you know, it's human nature that when you go through and you're reviewing something and you start to review things and you find something that's wrong, normally if you find one thing that's wrong, you assume that there are other things that are wrong, and you dig deeper and deeper and deeper. So that, you know, my suggestion is to go through, especially if we're talking about that. If you have accounting methods that are just plain wrong, I would really want to talk about exactly what method you were using, how far off it is, and so on. So, you know, I can't answer this question specifically, but my answer would be I really want to see exactly what it is when you talk about accounting methods that are unallowable that you used. I would want to see that so that, you know, if you're using the cash method of accounting and you're prohibited from doing that based upon tax law, that's something that we have a major issue with. Other things that I would want to talk through exactly just how bad that is and what type of hit you're going to have to take in what you're doing. But as far as the first thing as to, you know, did you do something like that, and you know that as soon as they pick it up, you know, my experience, and you know, I would talk to your tax preparer, talk to the people here. My experience is that almost all situations, especially if as soon as they pick up the general ledger or they look at something and they look at the repairs and maintenance accounts and they see that it's substantial, they're going to ask for that documentation. If you know it's really wrong, I would go through and see what's in there and see what I would be willing to give them up front and what I'm not willing to give them, and see what I can do and figure out what it's going to cost me to do it. You know, and am I willing to do that? Am I not willing to do that? Am I going to try and dance around it? But, you know, if you know that it's wrong, you probably have a major issue. Okay. So basically, that's change of accounting method. You know, if you have a method that is the wrong method and you've been using it and you know you're using it, I would want to talk to you or talk to some real good tax people. We have lots of good tax people here about what that method is, what it would have been the hit if you were using the appropriate method. So that's where I come down on that. Okay. You have to remember that there are things other than the new regulations that are in your favor and that are still out there. So that basically, if you don't qualify for that, you may still qualify for Section 179. So 179, we all know, or should know, is the immediate expensing of an expenditure of something you buy. The limit that you can take is massive. It's $500,000 a year. Right? And the phase out when you start losing that $500,000 is when you have acquisitions of $2,500. So basically, when we want to go back to the previous question that says you didn't do your repair regs properly, the question I would then ask is, should you have or could you have used 179 to avoid this situation? And depending on what year it was, what the rules were at that time. So that may mitigate a large part of that question. Now, the other thing you have to remember about 179 is it only applies to business property. What is business property? You know my little graphic down in the corner here, that kind of looks like a building. The reason is it doesn't apply to buildings. It doesn't apply to real property or to personal property used in residential real property unless it's 30 days. In other words, unless it's a hotel, motel, or something else. So that if the stay of the people is less than 30 days, then it will apply to that. Other than that, it does not apply to any real property. It doesn't include land. It doesn't include land improvements. So if you're putting a parking lot in, parking lot is a land improvement. Therefore, it doesn't apply. Does not apply to HVAC. I'm not sure how that got in there, but it's been in there for a long, long time. One more thing, and this is still here. We forget that it's here, but the other thing that is in there is bonus depreciation. So bonus depreciation says, okay, you had to capitalize things under the new regs, right? You've exceeded or whatever, you don't apply for 179. However, bonus depreciation may kick in. And bonus depreciation says that you can depreciate those assets up to 50% from 2015 to 2017, 40% in 2018, 30% in 2019. All of this is subject to, and I don't want to get into what may or may not happen on tax reform, but these are the rules as they stand now. Okay. I'm through for an hour. It's just about an hour, which is, faster than I thought I would be, basically because I'm not getting a lot of questions. And please, please, please ask questions about this. I am here. If you're embarrassed or whatever, to write the question here. Doesn't say who it is, but my contact is there. That is my cell phone number. I tend to take my cell phone with me hiking or cross-country skiing, as the case may be. But see what else you have. You can email me or just ask any questions that you have. So if there are no other questions, please ask them. Please, please, please. I don't see any more. I thought you had said that if the individual invoices are under de minimis, you can expense. That's true. So basically, remember what I said, and that, we go way back to the beginning. All right. This is fun. All right. We go back to the beginning of the discussion, and if you meet the de minimis exceptions, all right, if you meet that de minimis exception, and that's why I have the picture of the invoice there, if you meet that de minimis exception, you can expense, period. It is a de minimis exception. You can take it, end discussion. Right? No harm, no foul. You qualify to expense as long as you meet that de minimis exception, regardless if it's a betterment, regardless if it's a restoration, regardless if it's adaptation, it doesn't matter. You met the de minimis exception. You made the election. It qualifies. And my preference is, because it is unclear if it's required, that you have a de minimis policy based on these in your right-hand drawer that you can whip out and show. I hope that answers. What is this? Hang on. Capitalization so far. Wait a minute. Go to the beginning. Da, 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 da. I thought you said that. And why would you be able to expense the entire lobby? Theoretically, the way we did it is, and I'm not saying that the IRS isn't going to question if they should pick it up, but what we did in that case, they're asking how we did this thing for a seating in a lobby, is we took each seating arrangement, each table and chairs, and we had a separate invoice for one. When we ordered it, it was ordered on our order request that we sent in. Each one was separate. Each one was separate. Each one was separate. Now the IRS is going to come in and say, well, did you get any break on that? And in that particular case, the answer was no. We did not get any break by ordering. We did not get, it cost us anything extra, or would not have gotten a break if we ordered them all at once. But that's how we got around it. Now, remember when I first started off, I said sometimes you are able to do things that can be contrary to the intent of the rules because of the specific language of the rules. And this is a specific case of that. Is it intent of the law of the rules? Absolutely not. Is it the way it's written? Yeah, it is. Somebody else had a, wait a minute. Our capitalization policy, anything to expense to any software that needs to be renewed annually, but this year our new tax preparer told us to expense a piece of software that cost us $7,500 annually. Is that correct? So basically, I think what you're talking about is you have a license to use software, is the way I read this. So you have a license to use software, and you are paying $7,500 for that license to use software, which probably also means that they are coming in and they're updating and everything else. So that's, I don't consider that as a cost of the software. That is a cost of a license to use software that is used every year. I'm assuming that you can sit around and say, I don't want to pay you anymore. I'm not paying you $7,500. I'm taking the software off of our server, or you can come and take it off of our server and move forward. I'm assuming that that's the case, in which case I would have no problem with expensing that. And can you take the minimum section for tax purposes but not capitalize it for books purposes? Can I take it for tax purposes and not book purposes? This comes down to capitalization policy. In my view, in my reading of this, if you have a capitalization policy, that capitalization policy applies to both financial reporting purposes and tax purposes. So can you take something and expense it for tax purposes and capitalize it for financial reporting purposes? Probably, because you want to capitalize it so that your net income looks better. I would have a problem with that. Because I think that that's my capitalization policy, is my capitalization policy. Can I have a separate capitalization policy, one for financial reporting purposes and one for tax reporting purposes? There is nothing specifically that says that. There is nothing, if you remember when we talked about compliance for book and tax, I may just not check that box at all. I may leave that blank, which I probably don't have a problem with. And would I write a capitalization policy and put in there that says this capitalization policy only applies for tax purposes? Yeah, I would try it, and you know, it's distinctly possible that the IRS isn't going to care, because they're probably not going to care about your financial statements. Would your auditor care? I am not an auditor. I can't answer that question. I mean, I suppose I can, you know, run down the hall and go find one here. But I would ask your accountant, your auditor, or whoever's signing off on your financial statements, if they would have a problem with that, because, you know, would they consider that trying to game the system, in which case they may really have a problem. If I were an auditor, I would really have to talk to you about that a lot. So that's my answer. Let's see if there's anything else here. Well, we talked about how I'd be able to do that. I think that's all the questions that I see here. Are there any other questions or any that I missed? If there are, just type it in. I think I have all of them that I've answered. If I missed anything, you know, type it in, or give me a call. My phone rings in the car, so I can do the hands-free. Amazingly enough, I have not managed to have that broken in my car yet. Oh, so you have my phone number, you have my email address, you have both my email addresses. I am pretty much around most of the summer, so that if you have something, you can call me or email me. The firm knows how to get a hold of me. I will be, like I said, with regard to that bankruptcy case. Yes, it is a bankruptcy case. All right. However, I was talking to a couple of my friends here beforehand, and I said, you know, bankruptcy cases, you know, are a funny thing. And, you know, all of a sudden, this doesn't mean anything unless the operating business can't pay its bills. And all of a sudden, what happens when the operating business can't pay the bills, somehow they either have to make a deal with the creditors, or they're going to go into bankruptcy, and all of a sudden you now have a bankruptcy case. Especially you now have a bankruptcy case that's, you know, right here in Massachusetts, in eastern Massachusetts. And like I said, they did everything wrong. Everything that you could do wrong, they did, in my view. But I'm going to write up a little newsletter thing for that, and that will be out in the next couple of weeks on the Greg Rangray newsletters. I think that's it. Why would you choose to expense versus capitalize? Just convenience? No. The reason I would choose to expense versus capitalize, convenience is clearly one of them. However, the vast majority of business owners that I've dealt with over the course of time, if you have a choice of putting $1 in your pocket today or putting $1 in your pocket next year or the year after, are going to elect to put $1 in your pocket. And one of the ways that you put $1 in your pocket is to minimize your taxable income. And you minimize your taxable income by being able to expense as many items as you can. So basically the reason for expensing versus capitalization is to minimize your taxable income, put the $1 in your pocket now instead of the $1 in your pocket later. You know, that's been my experience over the course of a lot of years. But that's where I come from. Is there anything else? I think I got everything. So if there, I think that's everything. So if you have any other questions, you know where to find me. And again, my rule used to be, back when I was in the office all the time, my rule was that if you take me out to lunch, I would answer any questions you have at lunch. You know, now my thing is, you know, basically, if you're a client of Gray, Gray, and you know, they said call me to answer the question, I will spend as much time with you as you want. It's fine. If you're not a client of Gray, Gray, I have a slightly different rule. My rule is that, you know, I'll spend an hour with you. Hopefully that will make you a client of Gray, Gray. But, you know, that's kind of my rule as long as I'm around. I will answer my phone pretty much anywhere if I'm off hiking, especially if I'm hiking something that is a little bit hard for me. I may answer the phone and tell you I'll call you back. I do not answer the phone when I'm playing tennis, but pretty much everything else, or when I'm working out in the gym. But aside from that, I do answer the phone all the time, and I will always get back to you if it's, you know, something that's more complicated or whatever else. You can email me what you can and ask me to call you, and I will do that as well. So that's it. I hope everybody enjoyed it. I hope I gave you some things to think about. I don't see any other questions here. So I think I'm going to say goodbye to everyone. And wait a minute. So land improvement of $4,500 could be expensed this one time. Yeah, wait a minute. Let's go back. A land improvement, if you are audited, or if we're doing the de minimis, could be a land improvement if we're going back to the real estate items, all right, and we're going back to the small business exceptions for real estate. I would say the answer to that is yes. All right, so that basically if I'm qualifying and I'm zipping forward to my real estate here, if I qualify under the small business building exception, absolutely the answer is yes, because it's under $10,000. So that would happen. The answer to that is yes. I think. Okay. I think that's it. So if any questions you have, please feel free to call me or email me. I do answer emails. I do answer the phone. So if there's anything you need, like I tell everybody up in the mountains, you know where to find me. So thank you very much.